the Magnified video series, a quarterly deep dive where we look through the lens of the Antipodes portfolio, some key portfolio drivers, and how we're seeing markets today. I'm joined by Vihari Ross, Co-Portfolio Manager of the Antipodes Global Strategies. Vihari, hello.
Thanks, Sam.
Let's start with a look back on where we've been, in this past 12 months. And it's pretty crazy to think that this time last year, we were discussing the reopening of China, the end of its COVID zero policy, the potential for the US financial system to unravel, all against the backdrop of what has been the sharpest hiking cycle we saw in decades. But we've seen extraordinary resilience in markets. The US has consistently outperformed. We've seen the S&P push through all-time highs, as we've seen in Europe and even Japan, with the Nikkei pushing through 1989 highs. Not many commentators have really picked this. We really thought this recession was coming, or at least a little bit more economic weakness than we'd experienced. Vihari, how do we really get here, and how does this really persisted into calendar year 2024?
Well, I think, last year, we saw the Fed react really quickly, to some of the risks they started to foresee. They expanded their balance sheet, the liquidity environment was favourable, they contained the stress really quickly. And so that recession that everybody was predicting just didn't end up happening. The US consumer also proved resilient with that fiscal stimulus that we saw, driving the market last year. Actually just really supportive of the US market. Over in China, on the other hand, we didn't get the stimulus that we expected the CCP to go down that path. And that was after their self-imposed, property crackdown. So that market almost universally, started to be sold off. Despite sort of strong operating results coming through for some of the companies, that whole market ended up being weak. And I think some of that sell China type narrative ended up supporting other markets like India and Japan instead. And I think in the end, over the course of the year, after that bull market run, we ended up with an extraordinarily narrow subset of companies, driving market performance. By the end of the year, the top 10 companies in the US represented a third of the index, and that's an extraordinarily high level of market concentration that we found ourselves with.
Then this year, in the first quarter, we've seen a divergence of some of those names. Nvidia continued to push higher, almost triple digits this year, and names like Tesla down over 30% at time of recording, and Apple down close to 10%.
Yeah, so I think the thing, Sam, that's been revealed this year is something that we always knew to be true in that Mag 7, which is that they are not a universal cohort of companies. They are fundamentally different, and I think some of that performance that's been revealed is a reflection of those fundamentals coming to the fore. I mean, if we do look at them as a cohort for a moment, that Mag 7 is trading at about 30 times, but the earnings growth behind that 30 times is 20% per annum. The other 493 companies are trading at 18 times, but with a 9% earnings growth prospect. So I think the thing that needs to be reflected on here is, where has the share price appreciation been backed by fundamentals and where has it not? So it's not necessarily about how expensive mega cap tech is. Certainly on a stock by stock basis, there's evidence of overvaluation. But more broadly, where that overvaluation might lie. And I think some of what we've seen there is actually overvaluation in that quality of profitability factor. That's now at extreme levels. It's performed extremely well over the last 18 months. But now, certainly versus the value of value as a factor, it's approaching the extreme levels, in fact, levels that we haven't seen almost since the year 2000. And that's coming through on the consumer side, that traditional quality consumer side, as well as in that semiconductor complex, the cloud complex, where there's a lot of exuberance around the potential of AI. And I think for us, we're a pragmatic value manager. Are you getting what you're paying for? When it comes to the price you pay for an individual security, you've got to pay that right price, and importantly, not overpay for the growth that you're presented with.
Against this backdrop, to start the year, we saw growth continue to push higher and outperform over the first 2 months of the year, and the Antipodes global portfolios, both global long short and global long only, underperformed their relative benchmarks over the quarter. But towards the end, particularly in March, we did see a reversal in some of the drivers. We saw a bit of a broadening out in terms of sector performance. We saw energy and materials outperformed towards the end of the quarter, and regional performance strength in regions like the UK, Korea and continental Europe outperform the US towards the end of the month. How did that play, Vihari, into some of the portfolio drivers over the quarter?
So absolutely, first up on the broadening out, yes, market concentration can often be met by that broadening out, a change in momentum, where previous laggards might start to catch up in terms of performance. And we did start to see that in March in terms of the value factor starting to perform well, and other regions around the world start to perform well as well. When it comes to the Antipodes global portfolios, those that are familiar with us will know that we take that pragmatic value approach around the world. And, some of our contributors to performance really did come from a diverse range of sectors and regions. And that really did come to the fore over the quarter. To give you some examples, the biggest detractors was our underweight to North America, as well as not owning explicitly NVIDIA, Alphabet and Lilly. But on the positive side, we had a strong contribution from Oracle. It's really driving earnings growth through the monetization of AI and the cloud. And in fact, its cloud infrastructure business grew at almost 50% per annum at its most recent result. TSMC also contributed. They're again getting that AI tailwind with their leading position in chip manufacturing. They're getting pricing power as well, being driven by the demand for their products and services. We also had a strong contribution from Merck, which is a leading US pharmaceutical company. That business has a very significant blockbuster cancer treatment called Keytruda that grew at almost 20% per annum. And also Gardasil, the HPV vaccine people will be familiar with, also had strong growth. Over on the other side of the world, again, I said that contribution really came in a broad-based way. We had Daimler Truck come through that had almost 40% growth come through in that business. Again, that's an industrial cycle that's favourable for that business, and they also increased their returns to shareholders in both dividends and buybacks in the order of 2 billion euros over the next couple of years. Lastly, I'll speak to our European financials exposure that continued to contribute favourably over the last quarter, and I can call out there UniCredit, the Italian bank, that was a strong contributor for us over the quarter.
Sure, that's a very eclectic mix of portfolio contributors over the quarter, from traditional pharmaceuticals to European financials, and still capturing some of the tailwinds from the AI semiconductor complex. Now, we can't really talk about portfolio positioning without touching on some of the macro, Vihari. We've still got this stubbornness and the stickiness in inflation in the US that's keeping economic conditions relatively tight. We've got this property sector overhang to Chinese sentiment more broadly, and coupling that with the geopolitical risk that lingers, particularly this year in an election year. Is it safe to say we're in a pretty similar position to what we were last year?
So I think we find ourselves in quite a different place from last year, and the main reason for that is given how much valuations have moved. But from a macroeconomic perspective, I think this is actually an area where a lot of things have changed. Core inflation is coming down. We've had this sort of dance around the Fed needing that confidence around where inflation is going to land before they can have the confidence to cut rates. So we've gone from 6 rate cuts with no slowdown at all at the start of the year to now this more tempered 2 rate cut scenario. And that's in the context of the fact that inflation, as you say, has remained a little bit stickier, likely to stay in that 3% plus range for a little bit longer yet. Turning to the manufacturing side, that's a part of the US economy that actually has been really weak over the last 18 months. There's been a really weak industrial production cycle. That's actually starting to improve now, particularly when you look at forward-looking sentiment indicators, and that's something we're watching really closely when it comes to the resilience of the US economy as well. And what we're finding is because of those recessionary conditions, a lot of those industrials companies have been priced for a recession and presenting us with really compelling valuation opportunities that just don't exist in other parts of the market. And that's something that we can touch on later. The other thing I think to think about when it comes to the macroeconomy is, given where rates are and given that inflation's come down, financial conditions are actually quite tight in the US when we think about that differential. You know, people have used all of their excess savings that they, gathered up through COVID. You know, that's extinguished now. You know, the ability to get incremental credit is really hard. You know, to get a new mortgage is, an 8% rate in the US. To get a new auto loan is 9% in the US. And you are starting to see, you're certainly seeing strong employment data, but you are seeing little evidence of weakening at the edges. And an example of that might be, for example, the rate of people quitting jobs has actually reduced to levels before that of COVID. And lastly, of course, this is an election year. So, that high level of fiscal spending that we've come to expect is set to continue, if not increase. And that's really supportive a lot of investment tailwinds, including, reshoring of manufacturing, defence-based spending, as well as, sustainability-based spending as well.
So Vihari, there's a bit to unpack there. A few headwinds turning into potential tailwinds, but a few risks you're still seeing in light of the portfolio?
So Sam, I think on the risk side, that's actually an area where things actually haven't changed all that much, even though the can got kicked down the road from this time last year. The first, market concentration we've talked about and the potential change in momentum that can cause geopolitics, if anything, that's only accelerated as a risk, and certainly as far as news flow and the news flow cycle goes. Another risk that we're really paying attention to right now is, the debt and the servicing cost pressure that exists in these sort of highly levered corporate structures around the US in particular. That's that private equity space, the private credit space. A lot of those, business models are untenable, in a higher rate environment, and a lot of the servicing costs of those underlying companies that are really highly geared is now in that 10 to 12% range, and that's not sustainable forever. They're obviously holding out for rates to come down at some point, but it certainly presents a risk to markets, and it also presents a risk to the employment space. Given that cohort of companies actually employs a very substantial part of the US population. The other thing we're sort of mindful of when it comes to risk is, whenever the Fed has hiked rates, with this magnitude in the past, that's never happened before without an economic downturn. So something to be conscious of as well when it comes to our portfolio construction.
So Vihari, a few headwinds to markets perhaps and risks that investors should be mindful of as we head towards the end of the year. In light of some of the tailwinds also that you mentioned earlier, what have been some of the changes made to the Antipodes global portfolios this quarter?
So Sam, as I hinted at earlier, one of the areas where we're really seeing a lot of value is in that global cyclicals part of the market. These are businesses in many cases that have been priced for a recession, but are poised to, participate in the upside as that industrial cycle inflects favourably. What we're looking for, is, an idiosyncratic sort of source of upside, where those supply and demand dynamics are favourable. Example of that is a stock that we own, Nutrien, which is, participating in that fertilizer cycle, in terms of replenishing farm soil, which if you don't replenish, yields come down, and so there's an underlying reason to make that investment. We also have leaned more into our industrials and autos side of the global cyclicals complex. So that includes autos like Hyundai, Stellantis, Toyota. These businesses are trading at 5 to 10 times earnings, presenting us with really compelling valuation opportunities. But also industrials like Siemens Energy on the renewables side.
Vihari, if we can bring this all together, in a whole of portfolio view, can you just step us through how the portfolio is looking at the moment as we head again towards the back half of the year?
Yes, sure. So, if you look more holistically at the Antipodes global portfolios, the portfolio can be sort of organised around three key pillars. The top there is what we would call our mature/cyclical component of the portfolio. I just mentioned the extra weight that we've put behind that global cyclicals component. But that pillar also includes, dominant, local businesses, including Lowe's, including Meta, and also our financials exposure, particularly in Europe, as I discussed earlier as well. The second pillar there is businesses that are exposed to those structural investment trends, the mega trends that are going to be really formative over the next 5 to 10 years and beyond. Of course, that includes our investments behind all parts of the value chain in the cloud and AI monetization, as well as trends like the energy transition that the whole world is about to embark on, including companies like Saint-Gobain, which is a sustainable building materials business, as well as Siemens, which is a leader in automation around the world. So in light of some of those tail risks and some of those macroeconomic uncertainties we talked about, we've also rounded out the portfolio with our allocation to defensive assets. These are less economically sensitive when it comes to their operating performance. That includes allocation to the healthcare sector, pharmaceutical companies and companies like Alcon. We also have companies like Tesco on the staples side, but we also have a staples allocation, for example, in Latin America, companies like Sendas in Brazil, as well as FEMSA, which is a Mexican convenience store chain.
Picked up a little bit there of some regional tilts in the portfolio. Can you sort of give us a picture of what that looks like from a regional perspective at the moment?
Yeah, so from a regional perspective, we've maintained our underweight to North America. At this point in time, we have an overweight to Europe. When we look at our European exposure, much of those are European multinationals, meaning that they are listed in Europe, but they have operations all around the world, including in North America. We also continue to have a really constructive allocation to emerging markets in the portfolio. There's a true valuation opportunity that we've been presented with there. Many of these markets are trading on 15 to 20 year trough multiples, and as a value manager, that leads us to sit up and take notice. We've maintained exposure to, to Latin America, to Korea, and also we've maintained that exposure to China at about 10 to 11% of the portfolio. Again, there we see truly compelling valuation opportunity, a number of headwinds around the broader property cycle there, but that sell China narrative has actually enabled us to find compelling valuation opportunities in businesses that are national champions, that have structural tailwinds, that are high quality, without necessarily having to participate in that in that weak component of the economy.
Thanks, Vihari, and a really interesting deep dive into how the Antipodes global portfolios can be a diversifier from both a sector and regional perspective within client portfolios. Thanks for joining us today.
Thanks, Sam.
Thanks everyone for tuning in. Hopefully you enjoyed a deep dive into some of the drivers of markets so far this year, the positioning of the Antipodes global portfolios, and I encourage everyone to look out for the Good Value Briefing podcast available on all relevant platforms in the coming weeks.